Good day, everyone. Welcome to the episode 2 of Investors and Founders Unplugged, a webinar set up and created by Optimate. Today, I'm joined by Jed Ng. Jed is an ex-tech operator, has created the Angel School, and has done 2 successful exits as an angel investor. Today, we'll be talking about the building blocks of a successful syndicate. Jed, welcome. Happy to talk to you again and have a chat today on the session. Just maybe to kick off, any piece of introduction you want to say?
No, I think you've covered it all, Ollie. I mean, firstly, thank you for having me. I love what Optimate is doing for the venture ecosystem in Asia. It's a critical building block, so you guys are absolutely on the right mission. Besides what you've already said, maybe I'll just add on there that I'm a self-taught angel investor. I've never worked professionally in VC, so I've had to learn the skills by myself. And building on top of that, I also started building my own angel syndicate in 2020, and that's grown to over 1,300 LPs or investors today around the world.
Thanks, Jed. So let's just start with a few questions. Tell me about what prompted you to launch your first syndicate, and maybe remind us, when was the first syndicate you set up?
Yeah, I think the genesis for starting a syndicate, like most angel investors, is I wanted to scale up the impact of what I was doing. There are other economic reasons, of course, right? Because venture is such a long game. We deploy capital. It's completely balance sheet capital at risk for a very long time period. And we don't see a liquidity event for many years, if that. So starting a syndicate is about scaling capital. And I think along with that, you improve your diligence, you improve your deal access, you improve your economics as well. The catalyst for doing this really was that I started angel investing for a few years, for about 3-4 years. I had some traction, some exits, some data points that showed the portfolio was doing relatively well. And so I wanted to scale up for all of those reasons.
And talking about scaling up, you grew your LP network to 1,300 LPs. That's very impressive. Maybe you can share a little bit about how you started that. I mean, you started with the first one, I assume, and then you get to that number. How long did it take? What are the different milestones in reaching such a big audience?
Yeah, great question, Ollie. I think that the simple answer is brick by brick, it's step by step. So every single one of my 1,300 LPs I've spoken with, literally every single one. Some people think it doesn't really make sense because it's not scalable, but fundamentally, I think that in the world of investing or any field of investing, when you're working with people, relationships and trust is key, which is why you need to forge relationships with people. But the core principle for how syndicates, why that's the core principle of why syndicates should do it. The how you go about it, I think there are more or less efficient ways of doing it. So when I started out, one of the first things that I learned from having many reps of speaking to one syndicate, or excuse me, one LP after another, is actually, how do you actually script this out? What are the most common questions, and how do you do resistance handling, right? And now we've got it down to a playbook. And going back to my earlier point around relationships with investors being trust-based networks, I really credit this practice of speaking with all investors for the growth of our LP network. So besides the growth, something I do want to point out, and I think has been really powerful for us, is that every single one of our LP acquisition today is inbound, 100% inbound. So every single week, we get a steady trickle of new investors wanting access to our deal flow, which makes this really powerful. As you think at scale beyond critical mass, you theoretically have this investor network that is self-reinforcing, that grows on its own without having to do anything.
One of the key words you've used is trust. Building the trust with the LP network. So, how any tips on any insights on how you build this? Because we're talking to an audience. Some of our audience members might be interested in setting up their own syndicate.
Yeah. I actually have come to the view, Olivier, that syndicate building is a step-by-step, very repeatable process. I've learned that myself, and we teach this, as you know, in our programs, our syndicate program at Angel School, and we've seen this success being replicated with other syndicates as well. So I'm a firm believer that there is a step-by-step, and the high-level playbook is this. Number one, you need to start with your own investment thesis and have clarity of that for yourself. Then you want to build an LP base around this thesis. Where should you start? Well, the very simple thing is start with your warm network. Back then, when I was starting out, I didn't have the exits yet. Well, I had one very modest exit. And I had back touring already at that time, but it hadn't grown into like a very successful company. It was quite early days. There were some data points, but that was it, right? And so it makes a lot of sense to start with your warm network. Why? Firstly, your warm network are going to be people who tend to share a common history, professional background, and therefore they tend to have better thesis alignment with you. And secondly, they're going to give you actually the time of day to listen to you, right? And to actually pay attention to your deal flow. And I think you need to build that to a certain level. There are some metrics I do hold in mind. Once you have that, then you can start layering on your first deal. And then it's about seeing whether the metrics hold and whether you should continue scaling from there or actually kind of go back to fundamentals and shore up your investor network. I think that's the very simple 1, 2, 3 for me.
Makes a lot of sense. I mean, it's not something that happens overnight. About 3 years ago, you set up Angel School. So you've mentioned it a couple of times earlier. This is what you're very active on currently. What was the thinking behind setting up Angel School? Because it's got a unique proposition. I don't believe there's a lot of players out there doing this. Maybe you can share a little bit more about when you launched this, what prompted you to do that.
I think there's a few pieces to the puzzle, Olivier. The first one is that I'm just really, really good at it. Okay, so without sounding like a blowhard, let me give like the data point of why I say this. Firstly, we talked about the headline messages, right? 1,300 investor network. Today, 100% inbound investor acquisition. So the network grows on its own. We also have a full methodology or a playbook for making this really efficient and scalable. So scalability means that we know how to distribute deal flow, nurture interest, close capital. And 95% of the time, it's a self-service digital process. So this is one of the failings of most angel groups, right? Because it's necessarily people, community, and relationships. They get stuck in that mode where every time you have this deal, you need to talk to everyone one by one. And so that has a scaling bottleneck. So how do you go beyond that? So I believe that we've solved that puzzle with some very lightweight tech and process. Now, it sounds very complicated, but I actually manage this community with a $60 a month tech spend. We've written as large as seven-figure checks, single seven-figure checks into startups, and I do this all with no team. The point here is that we figured out the whole system, right? And so that's one piece, which is why I say we know how to do this. And I'm very happy to share this with other parts of the venture ecosystem, other people in there. The other reason of why this made sense to me is that if you think about the world of venture education, there are programs that help angel investors learn venture. Whether you agree or not, whether they're good or bad, that's a separate issue, but there are offerings. There are also programs that help people crack VC, either be a fund manager or get a VC job. And as far as I know, to my knowledge, there is no program specifically focused on building syndicates, which is completely unintuitive for me. So I think at some point, somebody's got to fill this gap, this niche in the market that's underserved, yet somehow deploys roughly $10 billion a year of capital, right? So how many of those market opportunities are there? So I'm willing to bet that we're really good at this and we have found an untapped market that's worth $10 billion. I think that's the kind of high level thinking.
One thing that you've mentioned is Angel School is obviously giving a playbook for aspiring syndicate leads or syndicates that want to set up. A big part of what we might not realize that much is the level of work when you are a syndicate lead required in terms of dealing with the founders, with the startups that are raising capital. And of course, you want to get the best deal for your network of LPs, but you also want to make sure that you are indeed helping and you have to do due diligence on these startups. So maybe you can share a little bit more about your views on how to negotiate the best deal with the founders without necessarily getting on the bad side of them, and how you on an ongoing basis you engage with these startups, because that's a big part of being a syndicate lead.
For sure. And I think that when we look at companies, the core skill that every investor needs, whether you're an angel or a syndicate lead or a VC, you need to learn diligence, right? That kind of skill set and continuously develop that over time. I think the other piece of the puzzle as an investor trying to get the best possible deal for myself and for my investors, it comes down to leverage. I think understanding that leverage is basically like negotiations. 90% of the decisions or the playing field is set by the time you sit down. And it's all in, a lot of it lies in information access and fact finding and things like that. So a part of that is diligence. Another part of the equation is capital, right? And this is why syndicates make a lot of sense, because if you're able to write a 6-figure check, or like in our case, we're breaking into the 7 figures, we start to have a lot more leverage in these negotiations with founders, right? I want equal access to information. I don't want to be in a situation where I get a partial data room and only the VCs get the full data room. It just doesn't make any sense. It's actually more work for the founders to like create two versions of a data room. But once we've decided to invest in the company, once we've made that yes decision, we're fully in with the founders. We want to see them to be successful. But how do you get involved? I think it's philosophical, right? There is no right or wrong answer. I generally am of the view that most investors think they're more value add than they really are. I don't mean that to say in a derogatory way, but building a company, as you all know, is you take 100 or 1,000 different decisions every single day. It's very hard for one single person to know so much that they can move the needle for you, right? So for that, from that point of view, we choose to be more pure capital investors. We want to have open communication lines with the founders so that we know what help they need, and when they do, they're communicating with us, and this is when we can mobilize the network, right? I don't need to get involved personally as a matter of ego. We just want the company to be successful. But if the founders are clear with what they need, then this is when we can plug in our network and get people mobilized.
I think you've touched it a little bit on the topic of technology, right? In the Angel School, you're making the process a little bit more digital. Maybe you can share about how the industry as a whole, and of course syndicate making, has evolved since you've started being involved in that.
Yeah, I think that as a whole, when it comes to building angel networks and running syndicates, we're still very near the starting line, and there's plenty of work to be done. The reality is that for most angels that want to start out and build their own syndicate, it's like throwing paint on the wall, honestly, right? They kind of go, I'm just going to go find a bunch of people we think are investors or LPs. We're going to find a company and do what we think is diligence. And then we're going to put that in a box and shake it. And it's trying to get electrons to collide. It's a very imprecise way. Process is important, yes. I think you also need the right level of technology from a syndicate's perspective, because the cash economics are so tight. You need to be very, very cost efficient with this because it's easy to overspend. It's also important to build your syndicate to get to critical mass, which for me means writing at least $100,000 and above check consistently, because otherwise, honestly, it's not worth it. And this is where guys like like Optimate come into the picture, and this is like where you enable these transactions to happen. Because frankly, from a technology and platform perspective, I treat my LP network as proprietary. I don't want to be on a platform, for example, like AngelList, where it's a one-way door. My LPs can go out, but I don't get anything back from the platform. But if you're not going to do that on a platform like AngelList, then what is the alternative? You have to figure out your own tech stack, yes. And then you also need to solve the SPV side of the puzzle, which is where you guys come in.
Yeah, thanks. I think one thing that you've highlighted, it's a lot of work, right? As a syndicate lead, I mean, you need to, of course, curate and cater to your LP network. You need to grow it. You need to interact. You need to find deal flow. You need to secure good deals. There's no guarantee that you will get both. It's both sides of the coin. It's tough. It's a tough gig, and typically the economics might not necessarily make it that you actually can do this as a full-time business. So maybe a couple of things I want to ask your opinion on. One, whether it's legitimate for a syndicate lead to charge fees to their LP network when they bring them in a syndicate. And the second thing, of course, if you do this, why would an LP go and invest through a syndicate as opposed to going directly to the startup? What does the syndicate bring that that you wouldn't have otherwise? The simple basic, I would say, mindset of an angel would be, why should I pay X% to the syndicate lead to the syndicate instead of me going direct to the startup? Maybe you can elaborate a little bit on that.
Let me address the first part of the first comment that you made, right, which is talking about the economics of this structure. Yes and no. I agree. What you actually probably are referring to is that the cash component economics of the syndicate vehicle makes it very hard to sustain full-time investing. I 100% agree with that, right? Which is why, in our way, for us, our strategy to have the education business is about cash flow, keeps the lights on, but it also happens to be part of a strategy where we teach somebody, we help them get into venture, we're expanding the network, and they're also going to follow our deal flow. So it becomes an LP acquisition channel as well. Now, that said, there are economic advantages that a syndicate has over, let's say, comparing a fund model. Specifically, we are taking carry on a deal level instead of the portfolio. right? So in a way, you should think of the return profile of running a syndicate. Every single deal that you do is like a financial call option, right? And so for that reason, our law, traditionally the way we think of in venture, applies less to syndicates than VC funds, right? Because you don't have losers on the portfolio that diminish your overall returns. I think the proposition for investors to be part of a syndicate, number one, somebody is doing the heavy lift of deal sourcing and doing diligence and sharing all of this nicely packaged up to LPs. You get the benefit of this with no strings attached. So you get to construct your own portfolio, the same like being an angel investor, except that you have to pay 20% carry. Is it worth it? That's up to the individual to decide, right? I think it is. I'm part of other syndicates, and if they offered me a deal that I liked enough, I would invest, and I have no issue paying 20% carry because you know what? You service the deal, everyone's got to eat. Could you, as an individual angel, go around the syndicate and approach the startup directly? Yeah, you could try, but is it worth it for you? I mean, fundamentally, if somebody is of that mind, it feels to me a little bit disrespectful, and it's not an LP that I want to deal with in the first place. And I think you also asked this question around like, what is fair economics on a syndicate? And this is my view. You might get a different opinion from somebody else. And that is, I think on the average deal for LPs, you should be expecting 5 to 7% of your capital going towards fees. That will cover a little bit of one-time management fee for the syndicate lead to help keep the lights on. It will go to cover the SPV costs. It shouldn't go much beyond that. That's an acceptable range for me. And in a successful exit, there's up to 20% carried interest. That's roughly the deal. If you're going to pay this, I would say expect to get a few things in return. One is basically it's a no strings attached agreement as far as I'm concerned. I wouldn't put up with a syndicate that expects me to invest X number of deals or commit Y dollars of capital a year. I fundamentally disagree with that. And the other thing is that whatever syndicate that you're following, make sure that they're doing diligence. The easiest way to do that is say, hey, show me the diligence that you did on your last deal or a recent deal, and to see if that meets your bar for what good looks like. And if it is, then I think the trade-off is fair. That's my opinion on it.
I 100% on a personal basis, I fully agree with you. I mean, I don't have the time to go, although we've got exposure to a lot of startups, to engage with the startup founder and negotiate and all of that. I don't have the time to look at this. Having a trusted syndicate lead, an individual I know is going to do a lot of the heavy lifting to find the deal, do the assessment, and go out there and propose it to me. I think it's just legitimate to pay a fee on this. Anyway, typically from the amount that I would invest, a percentage is taken for that. So if there's a successful exit, I get the return anyway. I get paid back on this, and I get a return, and I pay a carry on it. And if everybody wins at the end of the day, I don't really care. And I think it's very legitimate, knowing the amount of work typically syndicates, the good ones at least, spending, sourcing the deal, dealing with the founders, doing the LPs, and so on and so forth. It's only legitimate. I think again, that's my personal opinion. You were saying.
Yeah, I was going to build on the point that you're making here around economics, right? I think the other thing that sometimes comes up with investors is when they start comparing a syndicate with a VC fund, right? And I think it's a very false equivocation, right? You're sort of cherry picking data points, right? Firstly, I mean, what I would say is that, you know what, a VC fund will be taking 2% a year in terms of management fees. So over 10 years, it's 20%. So we could make the argument that a syndicate actually has better alignment with LPs than a VC fund. I think on a more practical level, it's a false equivocation because, well, do you have $3 million sitting around to be an LP in a small fund? It just disqualifies most people, right? So in that case, it's a non-starter in the first place. So like, why even make that comparison?
I would say, want to build up on that as well. Sometimes even as an LP, if I want to put a 10K ticket, maybe the startup founder wouldn't allow that, right? So it's also my cost of being able to access to a deal that I would not otherwise do to access. I know you take small tickets, but we've seen syndicates that take as little tickets as 3K, 2K. I mean, it's debatable whether they should be doing this, but you wouldn't be able to do that directly with a startup, right? What about something which is close to us? Legal and regulatory challenges, right? So of course, this is an industry, the funds industry, the investment industry is quite fraught with a number of regulations. Also, when you build an LP network, it's likely that you'll have LPs across the globe. What do you see? What do you need to keep in mind? What do you need to think about when you do this? And how do you mitigate these risks?
Yeah, it's a really interesting question. And I think any answer that anybody comes up with is going to be kind of incomplete, right? It's going to be an evolving one because the landscape is always shifting. As a starting point, as a principle, I would just say that accreditation regimes around the world are broken. They're just completely fundamentally broken structures, right? All they really do is say that somebody is an accredited investor because they can afford to lose that money. And philosophically, we're also equivocating sophistication with net worth, which I think like fundamentally, ethically, like there's some issues with that. But park that all aside. Another level is regulatory ambiguity. Like you probably know this, Ollie. There's news going around out of the UK with the FCA clamping down on Odin and some other players. I think Vauban/Carter is also affected. And it's really not going to be great for venture ecosystems if, on the one hand, regulators stay ambiguous. They don't have positions. They don't take positions on something. And so they create this climate where everyone's sort of guessing, or they come down super hard on it in a very draconian way, and then we can't operate at all. And I think it's better that, honestly, this is a much wider discussion. Like it requires like a whole episode in itself, right? But I think accreditation regime, what does that framework look like? And second, just regulatory clarity on where specifically angel networks and syndicates stand in this ecosystem, for what we do with an LP base around the world. If we need to go get the equivalent of a VCFM in 50 different countries, it's a non-starter. I might as well go shut down.
Jed, I fully agree with you. This is part of what we're trying to solve, right? As backend, as structuring, but I fully agree with you that landscape's changing. Every country has different regulations, and this is the challenge, right? Because when you have a network which is cross-border, we know whenever you touch the US, when it comes to regulatory regime, when you FATCA, CRS, all these acronyms, it can get very nebulous. But you're right, this is not the forum necessarily to delve into detail. I remember our chat actually around accreditation a while back. And I think this is
big issue with accreditation.
It doesn't really make sense. But anyway, finally to close this, significant learnings on your part. One key points that you want to share with our audience.
Yes. So earlier in this discussion, we talked about the economic structure advantage of a syndicate over a fund. The key challenge that people have with syndicates is actually the limits on scale. And what I'm learning is that the limits on scale on the syndicate are actually much higher than you realize if we approach it the right way. When I started out, I never thought we'd be over 1,000 LPs and writing $1 million checks. And this is not an exception. There are other groups with like 9-figure AUMs. I know other syndicate leads who have grown from 0 to 1,600 LPs in 1 year. Right? It's not an anomaly that it's something I can specially do that nobody else. Like we've seen this over and over again. So do the right things, but if you do it well, there's a lot of scale to this vehicle.
I think that makes a lot of sense. I want to say, Jed, thank you very much for all these insights. I believe in our audience, we've got aspiring syndicate leads, but also angel investors. So it's extremely helpful for our audience to understand that a little bit better. Now, you've been working a lot on Angel School. You've talked about it a little bit more there. Can you maybe share to our audience, very quickly what Angel School is and how they can find Angel School if they're interested in getting engaged or find out more about it?
For sure. Thanks for the opportunity to talk about our mission. When we started Angel School, it was built around building and launching syndicates, and our mission has evolved. The way I think about Angel School today is we are an accelerator for angel investors, helping investors all the way from their first check to leading syndicates, being that super angel. The way we do education is we have a formal program pedagogy that is really, really good. But more importantly, after that program is completed, I invite the investors to be part of my investment committee. We're creating a forum for skills acquisition, and we're segregating the need to write a check. So think about what that means. Right? We want angel investing not to be a pay-to-play proposition. This is how we're approaching this. If somebody is interested in this, our website is angelschool.vc. There aren't that many Jed Ings on LinkedIn. You'll be able to find me pretty easily. And I'd love to have a chat if somebody's interested.
Again, thank you very much, Jed. Fantastic chat, and I hope you've learned a lot through this. And if you do want to reach out to Jed, you can find him on LinkedIn, and you can find it through his website, angelschool.vc. Thank you very much.
Thank you, Ollie.